Guys, welcome back to the Independent Investor Channel. I roll these monthly videos out for you guys, the top stock picks. I'm constantly monitoring the landscape out there, seeing for new opportunities in the market and also looking to validate current positions that I have. I've got a pretty juicy list for you guys this time around. About half of the list are new companies that I'm actually looking at, companies that I typically look at no matter if I own it or not. And then about half of them are ones that I've already owned for many, many years. So a really diverse list here as we're moving into some volatility coming into this fall. I really want you guys to understand what I'm looking at. I do a deep dive in each and every one of these companies. I will not go into the specifics of the deep dive except for just highlight some of the things that I saw when I was going through that stuck out to me as we look to kind of condense a list together of 12 per month that are worth looking at. Let's get right into it, guys. The first one is Cardinal Health. The ticker symbol is CAH. This is kind of a fly under the radar in the healthcare, as I do think healthcare sector as a whole is in favor right now. Cardinal Health is a worldwide diversified business across a multitude of segments. It was amazing when I was reading about this company, how many feelers they have in the healthcare industry, whether it be from hospitals, whether it be from private practice, whether it be on the pharmaceutical side of the house. Cardinal Health sports a 4% dividend. It's grown for 24 years straight. It was a pretty impressive 13% CAGR on Cardinal Health. The company hasn't been around all that long, about 40 years, but I was really impressed. Cardinal is one of those companies that I currently do not own, and I've never owned this company. I own a lot of other large big pharma companies, but Cardinal Health has always been on my list as being a good candidate, a good solid diversified business in the healthcare. Second on the list is one of my absolute favorites. I've always made money with this stock. I currently do not own this as well. This is in financials, and this is BlackRock Financial. The ticker symbol is BLK. Dividend yield sporting at 2.6%. It's grown the dividend for 16 years. BlackRock hasn't been around forever. The CAGR on this 10-year CAGR at 15% is pretty good. So they've done a good job of growing the dividend. BlackRock, basically, for you guys that don't know, they manage the government and military pension program, that of which I'm part of. I currently don't own BlackRock, but BlackRock from a value perspective here looks really, really good. Trading in the low teens for valuation. It really stuck out and made my list this month of companies that we could be looking at here. Financials being, for the most part, out of favor. I do have two financials on the list here that are going to stick out to you guys, non-traditional plays, BlackRock being the first one. All right, next on the list is my absolute favorite sector in industrials. General Dynamics trades under the ticker symbol GD. It is also a worldwide defense business, missile defense systems, marine systems. It's one of my favorite industrials. All the industrials right here, defense industrials, are in play right now. General Dynamics sports an over 3% dividend at 312. It's paid that dividend and increased it for 26 years straight. Its 10-year CAGR is 10%. General Dynamics trades at a 13 forward PE. This company is been around the block for a few years. It's 121 years old. It was founded in 1899. One of those old, really well-established government contracts to offer out there, and in a 0% interest environment for a lot of people. These old Ironside companies that have been proven to pay the dividend out over the course of their history, man, really look attractive right here. Any one of these picks are not going to fit into any one of your particular portfolios, so make sure that you're doing your own due diligence when I roll these out. General Dynamics fits in my portfolio, and I do have a large stake in the company. The next one, I'll probably get some tomatoes thrown at me. It is a controversial pick. I think from a value perspective, Kraft Heinz food cannot be ignored anymore. The ticker symbol is KHC. Sports a dividend yield of 5.36. Obviously, no dividend, having been going through somewhat of a re-rack, going through some accounting scandal, which has really hurt the business. It's really been on a downtrend the last couple years, really getting their act together, to be honest with you. But right here at 11 times forward earnings, diversified worldwide snack foods business. Kraft Heinz is a money juggernaut. It makes a ton of money. And it really looks good here, again, with the idea of grabbing a nice, safe dividend yield here in the low interest environment. An absolute pure play, value play in Kraft Heinz food. The next is Philip Morris. This company makes money hand over fist. It sports a 6.29 dividend yield. It's paid that dividend for the last 12 years, modest 12 years. It does have a modest CAGR of 7.51, so it has managed to grow the dividend over time. I've featured Philip Morris before. It is a company that I own. Its payout ratio is staggeringly high at 95%, but this company makes a ton of money. Beat on the revenue side of the house in the last quarter. It just can't slow this company down. It's amazing how predictable that inflow is. And I think when we look from a cash flow perspective, Philip Morris really looks amazing on being able to maintain and pay that dividend. So if you got no capital appreciation on Philip Morris, I'd take the 6.29 dividend and live to fight another day. But I think you're getting an actual very attractive entry price here in Philip Morris in the low 70s or to mid 70s. I think that's a really good range for entering the stock here. Next is Abbvie, their flagship drug being Humira, over a 5% dividend yielder. Abbvie is a fairly new company. It's only been around 7 years. It's got a 5-year payout growth rate of 20%. So just some of those highlights that came to my attention when I was looking through the company. Just really, really interesting. The next one is somewhat of a contrarian play here. General Electric, obviously on a turnaround here. Very interesting. The tell for me was in the balance sheet. General Electric has basically cut itself in half. It's increased its cash position and it's lowered its debt by about half. It's trimmed its market cap by about half as well, based on what I see here. This is really a play, and not to ignore the good work that Larry Culp has done. Win, lose, or draw, this guy has basically taken and made General Electric a lot more lean and mean, and it is a fighting machine right now. It's staying recessed now because it's tied to the hip to Boeing, and in their aviation department here, having got rid of GE Pharma, which was a great move, spearheaded by Mr. Culp himself. It's been able to embolden the cash position of General Electric. This is a turnaround play, not for the faint of heart. But if you were looking for one of those old legacy plays right here, General Electric makes a ton of money. It's still a $53 billion company. Looks really attractive right here. I currently don't own it, but at 16 times earnings, it's really starting to creep into that value play perspective in industrials. And I think for $6 a share here, this is going to be one of those that we eventually look back on and wish that we would have bought it. It's just that simple. There was really nothing that I saw that wasn't positive now and just specific indication that the company is turning itself around. And General Electric currently right now is no news is good news. So one to really look at, not for everyone. I wanted to throw some contrarian plays in. I've got two of them on the list. General Electric I currently do not own, but I may look to take a position here in the low 6s. I think it's a screaming buy right here. That's just what I'm looking at. The next on the list here was one of those dividend kings that gets overlooked a lot. It's Emerson Electric. The ticker symbol is EMR. Sports just over a 3% dividend and has a 63-year payout schedule. Now, the dividend growth is somewhat anemic here, so we're not buying Emerson Electric for that potential. We are, in fact, buying it for the dividend safety and security. 63 years cannot be ignored. Again, if you're looking to get a little bit more performance, but you're looking to enter into some of these safe and sustainable companies out there. Emerson doesn't get talked about very often, and I don't think it gets talked about enough, to be honest with you. And so we want to look at Emerson Electric here. I didn't have the forward PE, but I think that it was fairly attractive here to get into this old industrial electrical company in EMR. AT&T has made the list for the last couple months. AT&T sports a dividend of 7.33, trades under the ticker symbol of T. It's got a 20-year payout schedule, so really attractive there. Right now, guys, it's trading at 8 times. Again, in this low interest rate environment, AT&T makes a ton of money. Their payout ratio is attractive. I think they'll have no problem continuing to sustain that dividend. And for certain portfolios out there looking for a little bit of a dividend yield in their portfolio, AT&T looks really good. I'd rather own AT&T than I would own bonds. And for that, I think the entry here from a value play at 8 times at $28 a share, AT&T looks really attractive from what I saw. The best value play that I saw, and the only technology play that I have on the list this time around for you guys, is Cisco Systems, traded under the ticker symbol CSCO. Sports a 3.68 dividend, 9 years of payout, a 5-year dividend growth of 13.27, and a price to earnings ratio of 13 times. Cisco's been around for a long time. It falls into that old tech category that I really like right here from a value play, from a dividend growth perspective, and a pure play dividend value in technology. So if you're looking to place a cornerstone in the portfolio with some old tech, Cisco is worth looking at least adding to your watch list and monitoring it here. It's crept below $40 here, and I think anything sub 40 or especially below 40 is a really good entry on Cisco. The next is the second offering in the financial space. Citigroup is a diversified international financial play here, sporting a dividend just shy of 5% at 4.71, an astronomical 5-year dividend growth of 116%. This company is making money hand over fist, and it's trading at an extremely recessed valuation. 13 times right here, guys. Citigroup falls into the #1 financial right here. I do own a large position in it. I'm thinking about doubling the position here because from a screaming perspective, very rarely do you get an opportunity for a company like this to go so deep in its value to not get as much attention as it should. So absolutely Citigroup, ticker symbol C, belongs on each and every one of your guys' watch list. The next is the second contrarian play here, but Boeing, traded under the ticker symbol BA, is absolutely worth looking at here, guys. Boeing has really been crushed. It's really difficult to talk about Boeing not having a dividend growth history. It's really actually sad to talk about this fine industrial company. It does have about one of its 3 legs working right now because they've got to work out their aerospace business. Their defense business is holding strong. Right here, it's come off of its highs because they've really struggled and had some delays with the FAA approval of their MAX jets. Really got to get that stuff straightened out, but from a contrarian play, 160, 170 bucks of entry here on Boeing is really attractive. The last name I will offer with the theme of industrials play right here in value is ticker symbol RTX. This is Raytheon. Raytheon is a dividend aristocrat. It's paid the dividend for over 27 years. It's got a sports yield of 3.23%. Probably the most expensive stock on this list at 20 times earnings, but it's worth it. These guys are diversified across 5 spaces: aerospace, missile defense systems. It's one of my favorites, if not my favorite, in the defense sector. I own a very large position in Raytheon Technology, and it belongs on your guys' watch list, or if it fits in your portfolio, you want to make sure and do your own due diligence and make sure that you're verifying everything that I'm talking about with the numbers that are thrown out. Now remember, guys, when I throw out these stock picks every single month, I'm constantly monitoring the landscape. And I usually keep a list of those that float to the top, really trying to create value for you guys in what I'm seeing out there in the landscape every single month as the stock market continually provides value at all time, looking to provide that value back to you guys. Guys, if it's your first time to the Independent Investor channel, want to make sure and subscribe to the channel. Leave your comments at the bottom of what you guys are looking at for stock picks going into October. Really like to hear what you guys are looking at. For you new investors out there, this is an awareness piece to the stock market as to what products are out there, what companies I'm looking at and actually invest my own money in. I want to share the message with those folks out there that need an introduction to the market. We provide that awareness and education piece on the market. Guys, thank you so much for tuning into the video, and good luck in your investment future.